Hello everyone. Uh, Welcome to the first class of SP7 and SP8. So today this is the combined class. We are trying to understand what you all have done till now, and we also start with something. Firstly, I would like to start with an introduction. I am Anurag Gupta. I am a general insurance actuary. I'm working in reserving background for past 4 years. I'll be taking SP7 and SP8 with you. We'll try to complete the syllabus and will try my best that you all pass in the first attempt. So let's go. If you can introduce one by one. Anyone? Madhu, Garima, would you like to introduce yourself?
Sure. Hi, I'm Garima, and I'm planning to appear for SP7 in the November date. This will be my first attempt, and I come from a pricing background. So, so I'm looking forward to, clarifying more concepts on reserving side as well through this class.
Hmm. And what about you, Madhu?
Hi, so I'm Madhu and I'm working in the Accenture. I've worked in both reserving and pricing, so have around 3.5 years of experience in JI. And this is like my second attempt for the SP7.
Okay.
Yeah.
So, so this is your second attempt. You must be knowing most of the concepts.
Yeah.
If you like to share your experience, what all mistakes did you make in your first attempt, so that Garima, who is
Um,
student for the first time, can learn.
in the first attempt, the main problem with me was I couldn't complete the exam.
Okay.
I think that was the only one issue. I found it bit lengthier and
And you both are appearing from IFOA.
I'm appearing from IFA.
I'm appearing from IAI.
Oh, understood. So yeah, as Madhu mentioned, with specialist level paper, this is one of the challenge, completing the paper in time, because at times when you're writing the paper, you have a lot of things in mind. You think everything could be written down in the paper, but again, you need to be careful about how much marks, what is the weightage of the question. So we learn everything, how to tackle questions, how much to write, and how to target completing paper in time, because this is uh, very common. I hear it a lot that although people know the answers, but they're not able to complete the entire paper in time. So go. Let's start with today's class. So, did you all started with watching videos, or uh, you are doing self study? What is the update?
I'll have to check with the videos part. I'm not sure if I have the access yet.
Okay,
But I have studied SP8, so I believe the first 8 to 10 chapters are similar for SP7 as
okay,
well. Yeah.
okay. So you have cleared SP8.
No, no, I gave the attempt this time. The results are still not out yet.
So you must be familiar with the initial chapters. So today we are aiming to start with reinsurance only. The starting two chapters with reinsurance, the background and the types. I believe both of you have the knowledge of it.
Yeah.
So That's the case. We can, like, thought we can discuss it, but I think there is no point discussing the chapter. Let's jump to the question. This is SP7 2010 September attempt question. This is a very common question. I don't know whether you all have attempted it or not, but this gives you a very deep understanding of XOL and quota share reinsurance type, uh, about aggregate deductibles, how layers work, how participation work. So it gives you a wholesome knowledge about the understanding of XOL and quota share. So, like, if we can do a small recap, if you can tell me one by one, what are the advantages or features of quota share and XOL treaty? So, like, when I say quota share reinsurance, what are the features of it? How do premiums get distributed between the insured and the reinsured? How do losses get divided? Why do company prefer quota share and XOL? Those kind of
Uh,
features.
So for the quota share, we share a part of our premium, like percentage wise, we share a proportion of our premium to the reinsurer, and in the same way, our losses are shared. Like if we get some amount of the losses, then X% will be paid by us, and we will get a recovery for the 100 minus X% from the reinsurer. And whereas in the XOL, we have the limit. If our loss um, exceeds that limit, then the amount above that limit will be covered by the reinsurer, and there must be a capping on the amount that the reinsurer will be covering. Like suppose we got a loss of around 20 million, and our retention is 10 million, then 10 million, and also the insurer also has capping, like he will be covering from 20 million to 30 million. Then the in this case reinsurer will give us uh, like 10 million. They will
If
get a
uh,
recovery
I
of 10 million.
if I write that 5 million excess 10 million, uh,
Yeah.
5 million excess 10 million, then what would be the attachment point and the limit?
10 million is the attachment point and 15 million is the limit.
15 million is the limit. So we have a actual cover from between 10 to 15. So this is very important part. You need to understand at what point will the reinsurer enter and at what point the reinsurer would exit. So any claim below 10 million is in insurance company's bucket, and any claim that is above 15 million would be again falling into insurance company bucket. So as correctly mentioned by Madhu, for quota share, we divide the premium and the losses in the same proportion. So we decide what percentage of our losses would be covered by us and what percentage would be ceded to the insurance company. If we are saying that we have a 20% quota share, it means that 20% of all the premiums that we collect would go to the reinsurance company, and 20% of all the losses that we have suffered will also be recovered by the reinsurance company. So this is the basic feature where in quota share both losses and premium are equally shared by the reinsurer and insurance company, and for excess of losses above a threshold is covered by the reinsurance company, and it has a limit that beyond that it would again fall into insurance company's bucket, right? We again have some commissions working in quota share, which is not there in XOL business. Since for XOL we are pricing for the limit that we are covering, so giving commissions uh, be won't make sense, because if we are getting commission, we could might as well charge a lower premium or a higher premium for exchange of commission. So commissions only work in quota share, and for Actuarial, it's only premium given to the reinsurance company and loss recovered whenever the loss is between that limit. Right. So if we start with the question, it says that a large general insurance company write a small but growing commercial property. So how to read a question? Whenever you are reading the question, you need to pinpoint what are the keywords that the question is targeting. So this large general insurance company writing small but growing book. Small and growing is also important, and other thing which is important is commercial property. What kind of business it is doing, how developed it is, and what is the position of the insurance company. It says that its policyholder ranges from small retail to large manufacturer company. The property book is protected by a combination of risk excess of loss treaty and quota share treaty reinsurance. For both excess of loss and quota share, we have a treaty working on. So there are two type of arrangement: a treaty arrangement and a facultative arrangement. Like in a treaty arrangement, there is policy, like there is rules that work, and if a policy falls under the list of rules, it would be ceded to the reinsurance company, right? And for a facultative reinsurance, it is a specialized reinsurance taken for a specific risk. Like whenever you are insuring a large uh, institute or a very high risk, then you go to the reinsurance for the purpose of ensuring that specific risk. Whenever you are having a tailor-made policy for a specific risk, it is a facultative arrangement. And in other case, it's a treaty arrangement. So we are dealing with treaty arrangement over here. This treaty reinsurance is purchased from 1st January. So it's also saying that the treaty renews every year on 1st of Jan. The risk excess of loss reinsurance policy is purchased on a loss occurring basis, and the quota share is purchased on a risk attaching basis. So again, keyword to the question that risk excess of loss is on loss occurring and quota share is on risk attaching basis. The first question is a theory question which asks us to define what do you mean by loss occurring and risk attaching policies. So anyone, what is the meaning of loss occurring and risk attaching?
A loss occurring policy covers the losses that are occurring within the treaty period. For example, if the treaty period is Jan to December 2022, then all the losses occurring during that period only will be covered, and hence the accident year is important to us for such treaties. And in case of risk attaching, any losses that are occurring pertaining to a policy that falls within a treaty period. So, for example, in case of a loss occurring from a treaty, from a policy which had the treaty period Jan to December 2022, but the loss occurs say in 2023, then that policy will be covered under the risk attaching treaty. So, in this case, the underwriting year is important to us.
Yes. So correctly mentioned, whatever you needed to pinpoint that for loss occurring basis, uh, treaty is effective for policies in which in the year in which loss occurs, and for attaching basis, it is the year in which they were underwritten. So underwriting year for underwriting year for risk attaching, and accident year for loss occurring. Now let's come to the numerical part. It says that the quota share cession percentage depends on the treaty year, with each treaty running from 1st January to 31st December. The quota share cession rate is 50%, 30%, and 20% for 2008, 9, and 10 treaty years respectively. The table below sets out the key feature of the risk excess of loss cover for each treaty year. So for quota share, we have been given this paragraph that quota share का cession percentage is 50, 30, and 20 for each respective year 2008, 9, and 10. For excess of loss, we have been given the layers in which it applies in each specific year. So for 2008, we have three layers of quota share, three layers of excess of loss. First layer is from 2 million, a limit of 5 million, which means 2 to 5, correct? The second is from 5 to 15, a 10 million limit. And the third one is from 15 to 30, because we have a 15 million limit. The 15 plus 15, 30. So a good practice over here is to, instead of working with the access point, where attachment point and the limits, we write the layers. So the first is 2 to 5, second is 5 to 15, and the third is 15 to 30. And in all the three layers, it says that we have 100% placed the in reinsurance. 100% placed, what does it mean? It means that whatever loss will occur between the layer will be fully paid by the reinsurance company. So over here, if we see for 2009, second layer, it says that the loss is only 80% placed. So what do you mean by 80% placed? Like, it says that if the loss is between 15 to 20 million, only 80% of those claims would be paid by the reinsurance company, and the rest 20% would be paid by the insurance company only. So why does a insurance company want the insurance company to participate in its layer, if you can say? Why are these arrangements very common for high layers? So, like I'm asking, that we often see that for very high layer, for excess layer policies, it's often seen that not the entire limit is placed. There is always some participation from the insured, from the insurance company. So, why does a reinsurance company want the insurance company to participate in its layer?
To ensure there is no anti-selection or the insurer is not passing the bad risks by participating themselves also.
Yes. So the two main reason is anti-selection and moral hazard. So the reinsurer has a fear that he might be selected against, and the fear of moral hazard that when insure when the insurance company know that beyond this limit all the losses would be bear by the reinsurance company, he might be reluctant in giving high compensation, because he is not impacted by it. So, to reduce that risk, the reinsurance company often want that there is some kind of participation from the insurance company in very high excess layers, so that they don't just distribute the money, they don't just pass on money like this. So it's always in their interest as well. So they insist on having some participation. So over here we see that for 2009, the second layer has only 80% placed, and also we have an aggregate deductible to it as well. So what do you mean by aggregate deductible, and how will it work in this scenario? If we take an hypothetical example. So an aggregate deductible is the amount is first reduced from the recoverable part of the loss before the actual loss is paid. So in this scenario where you have for 2009, where you have 2.5 million to 5 million there, and then 5 million to 20 million there. So in you have a 2.5 million aggregate deductible as well. If there is a loss of say 2 million, if there is a loss of 2 million, will this aggregate deductible get consumed or not? If there is an actual loss, a ground up loss of 2 million.
No.
Yes. So the aggregate deductible only get consumed when the losses fall between the insured limit. So over here, since the limit which is reinsured is 2.5%, 2.5 million to 5 million, if the loss is above 2.5 million, then only it will erode the aggregate deductible limit. It will eat up the aggregate deductible limit. So say if we have a 4 million loss, first loss is 4 million, it is above 2.5 million, it is 1.5 million above 2.5 million. So in normal scenario, when there is no aggregate deductible, the reinsurance company would pay a 1.5 million loss. But since there is an aggregate deductible, this 1.5 million would be first reduced from the aggregate deductible limit. If we reduce 1.5 from aggregate deductible limit, we would be left with another 1 million. So that means for the first loss of 4 million, nothing would be paid by the reinsurance company. All the losses would be paid by the insurance company only. Again, there is a 2 million loss. Next loss is of 2 million. It doesn't cross the threshold of 2.5 million. There is no participation for the reinsurance company. So there is no question for aggregate deductible getting consumed. Now, after second loss also, we are left with 1 million of aggregate deductible still there. Now, if the third loss is of 5 million, in this scenario, 2.5 million loss would be covered by the reinsurance company. We still have a aggregate deductible of 1 million. We will reduce this 1 million and are left with 1.5 million. So what does it mean? That in the third loss, the reinsurance company would pay 1.5 million and the rest 3.5 million would be paid by the insurance company. So after this three loss, 4, 3 and 5 million, we see insurance company and reinsurance company. For first loss, all the losses paid by the insurance company and 1.5 million of aggregate deductible is eroded. For this, all the 2 million is paid by the insurance company, no erosion. In this, 3.5 million is paid by the insurance company, 1 million is eroded, and 1.5 million is paid by the reinsurance company. So whenever you are dealing with aggregate deductible, make sure that you have this kind of table and working going at the back of your mind so that it's easy and like in the first go you would be able to understand what are the features that you need to consider. So the next for 2010, again there is an aggregate deductible and the entire 10 million is paid by the insurance company. 1 million is eroded and 1.5 million is paid by the reinsurance company. 1.5 million is paid by the insurance company. 1 million is eroded and 1.5 million is paid by the reinsurance company. 1 million is eroded and 1.5 million is paid by the reinsurance company. 1 million is eroded and 1.5 million is paid by the reinsurance company. 1 million is eroded and 1.5 million is paid by the reinsurance company. 1 million is eroded and 1.5 million is paid by the reinsurance company. 1 million is eroded and 1.5 million is paid by the reinsurance company. 1 million is eroded and 1.5 million is paid by the reinsurance company. 1 million is eroded and 1.5 million is paid by the reinsurance company. 1 million is eroded and 1.5 million is paid by the reinsurance company. 1 million is eroded and 1.5 million is paid by the reinsurance company. 1 million is eroded and 1.5 milli layer is placed. Now, when the treaty details is over, let's see what are the losses that we are dealing with. It says that one of the property underwritten has an property underwriter has asked you to calculate the total reinsurance recovery that the company should make for his two largest property losses. So we have this two loss, A and B. It says that Smith Food has a fire claim for a gross incurred loss of 8.5 million. Smith Food policy incepts at 1st December 2008 and the fire was noticed on 11th of November 2009. And for yellow plastic, it's a food flood claim, gross incurred loss of 12 million. Yellow plastics renews every year. So for yellow plastic, the reinsurance is for every year. But for Smith Food, it's only for 2008. It incepted in 1st December 2008. And one of the yellow plastic factories was flooded in February 2009. So we are given with the information that treaty starts every year and the loss is on first is on February 2009. Then it says that the underwriter note that the loss are applied to an aggregate deductible in order of date of loss. The next largest gross claim has have impact have impacted the account between 2008 to 2010 was 3.2 million related to fire event in January 2009. So again, there is a third loss of 3.2 million where the policy was from between 2008 to 2010. We don't know the exact year of the policy. It says it ran between 2008 to 2010 and the fire was taken place in 2009. We need to set out the reinsurance recovery for each of the Smith Food yellow plastic, explaining all the assumptions that we make. Right? So, how to start with such a question? There are a lot of information to observe over here. Firstly, what is the limits? What, how much it is placed? Quota share reinsurance. What are the session rates each year? And this timeline as well. So in such a question, it's very easy if we make a timeline and understand how the events have taken place. So we see we are dealing from year 2008 to 2010. So let's first draw a timeline. 2008 to 2010. In between we have 2009. So let's write down the events, how they have taken place. So first, it is saying that the aggregate deductible is applied on how the losses have occurred in the sequence, how the losses have occurred in order of date of loss, right? So let's first identify which loss took place first and which was in later stage. So we have three date of loss: January 2009, February 2009, and November 2009. So all the losses took place in 2009, January, February, and November. Cool. So let's first write this. 2009 may we have January 2009 loss. We have February 2009 loss, and we have November 2009 loss. Right. Now let's see when was the policy inception date, because we are dealing with two type of insurance, quota share and actual. One is on loss occurring and another is on risk attaching. So we need both the dates. Food, Smith Food was in 2008. So Smith Food is the last line, November 2009. So this policy was in December 2008. And what is the session percentage for 2008? The session percentage for 2008 is 50%. 50% quota share. Okay. Now the next one is over here. It says that it renews every year in 1st of January. So for yellow plastic, it would renew on the 1st of January. So renewal is also January 2009. This is yellow plastic. This is Smith Food. And the one, we are not sure about the next largest loss have impacted the account between 2008 to 2010. It says that it has impacted the account between 2008 to 2010. It doesn't gives us the information when the policy was written. So what we would do, since the loss was for 2000, January 2009, the underwriting year could have been only 2008 or 2009, right? Since we are dealing with loss account from 2008 to 2010, for a loss that happened in 2009, the underwriting year could only be either 2008 or 2009. So what we would do, we will take a scenario based answer over here. We would give an option whether it is, we will look into it. So let's now calculate the losses for the reinsurance company, insurance company, aggregate deductible, erosion, and everything. So the first one is Jan 2009 loss. We don't have a name for it. The second is February. February was yellow plastic. February one was yellow plastic, right? So Jan 2000. Right. We have yellow plastic and Smith Food. It was on Feb 2009, and this is November 2009. Quota share recovery, aggregate deductible, then we would have excess of loss, remaining would be the insured loss. The insurance loss and insured loss. So, so the first loss is of 3.2 million. 3.2 million. Second is of 12 million, I guess. 12 million, and third is of 8.5 million. 12 million, 8.5 million. Attachment year for first loss is not known. It is either 2008, sorry, not attachment point. The underwriting year is either 2008 or 2009. For yellow plastic, it is 2009, and for Smith's board, it is 2008. So, what would be the reinsurance quota uh, share for this loss for each year?
I think 1.6 for 2008.
1.6 since it is 50%, and for 2009 it is
0.96.
0.9 million. Cool. So similarly, for yellow plastic, it is 2009. Let me see. Hmm, just do that. So for yellow
Sir,
plastic,
it should be 0.96 million for the 2009 for Gen 2009 loss.
196 million. Cool. For 2009 yellow plastic, it is
3.6 million.
3.6 million, and this is 50%.
4.25.
4.5 million. Quota share was fairly easy because there is no aggregate deductible concept over here working, and we just have to apply the excession percentage. Now let's see how the aggregate deductible will be eroded. So if we have 50% or 30%, what would be the remaining? Remaining loss is 1.6 million, or it would be
2.24.
2.24 million. Right. The loss is for 2009. For 2009, if we can write the layers, this is the layer 5 to 2.5 to 5 and 5 to 20. The second one is 80% close. So 2.5 to 5 million, 5 to 20 million. This one is 80%. This one is 100% raised, and we have a 2.5 million aggregate deductible. So for first loss, the loss after quota share recovery is either 1.6 or 2.24. So which means it hasn't crossed the first layer attachment point. There would not be any recovery from the reinsurance company. Hence, there would not be any erosion of the aggregate deductible. So the aggregate deductible erosion is zero. Excess of loss recovery is zero. Reinsurance is either 1.6 or 0.96 million, and hence the insured loss is either 1.6 or 2.24 million. For yellow plastic, the loss after quota share would be
8.4 million.
8.4 million. So this is crossing the first layer and also the second layer somewhat. So we have a 2.5 million, which is per insured. Next 2.5 is first layer. Now 3.4 million is second layer, right? 2.5, 2.55 million and 3.4, 8.4 million. So this is insured portion. This is the portion which is covered in the first layer, but would be eaten up by the aggregate deductible. And this one is the reinsurance company would pay, right? So if we say the aggregate deductible erosion is 2.5, 3.4 million is excess of loss. So the total reinsurance recovery would be 7 million, and the remaining 5 million is insured. Correct? So 3.6, 3.4, 7 million is recovered by the reinsurance company, and the rest is paid by the insurance company.
So
Now,
shouldn't we apply that 0.8% here at the, like, 2.5 million
oh,
will be recovered directly and then we should not.
correct, correct. So over here we missed one thing, that for the second layer it is only 80% placed. So three, 80% of 3.4 million would be recovered. So the recovery would be of 2.72 million. So the total recovery is 6.32, and the reinsurance is 5.68. Correct. And for the last loss, with food loss, we see that the remaining loss after quota share recovery is 4.25. 2.25 is insured loss, so the remaining 2.25 minus 1.75. Over here, since the aggregate deductible has eroded, there is no aggregate deductible consumption. 1.75 million is actual first layer recovery. Total recovery would be 6 million and 2.5 million insured insurance loss. Is it clear? Let me know if you have any doubt in this.
So just one question. Can we first
Yes.
apply the actual recoveries and then we apply the quota share on the remaining amount? Is it possible? Like if we do it that way?
Mm, So, see, there is a concept of inuring
Yeah.
reinsurance. So, quota share always work first before excess of loss,
Mm-hmm.
because it is a part of inuring reinsurance. It first reduces the sum insured, then on the remaining portion the XOL applies. So, like most of the, or almost all the cases, quota share applies first, and then excess of loss applies. So this is the nature of how the reinsurance get applies to a loss. So if you have, say, if you have some facultative treaty. So first you will apply that facultative treaty.
Hmm.
Then on the net loss, after applying this facultative on net of fact loss, you would apply a quota share first, and then you would apply a excess of loss. So this is the sequence in which the reinsurance get applied. So it's always first the facultative, then from treaty it's excess of loss, quota share, and then excess of loss. Non-proportional treaties get applied later on.
Okay. Thank you.
So, so first part, first part of this question is done. We have calculated. The second part is writing the assumptions. Writing what are the assumptions that we have followed. So if you could tell what assumptions have we taken. So if we see how we have worked, we could easily write down what all assumptions have been taken. So for reinsurance, we have calculated the quota share. For excess of loss, we have calculated the recoveries. We have stated what is the reinsured recovery, and then the remaining of the loss, we have said that it is the insured's loss, and this is what the insured has paid. In this calculation, we haven't thought that it might be possible that whatever recovery we are stating, we might not be able to recover that from the reinsurance company, or the reinsurance company might default, right? We haven't taken this scenario that the reinsurance company has default or the reinsurance company might default. So the first assumption is no reinsurance default. So the reinsurance doesn't default. The second assumption, we see that for excess of loss reinsurance, there is always some additional premium that is paid, the reinstatement premium that is paid by the insurance company, right? So for yellow plastic loss, we see that both the first and the second layer has been consumed. First layer has been consumed entirely, and second layer, some part of it was consumed, right? Again, in Smith Food, we were able to make recovery from the first layer of the excess of loss reinsurance, right? For the same year. So what do we assume over here? That there is unlimited free reinstatement. Once you erode your excess of loss limit, when the second loss comes in, your limit is again reinstated free of cost. We are not paying any premium for reinstatement. So we assume unlimited, unlimited free, free is the keyword, reinstatement. Because there is often a case that the reinsurance company might allow unlimited reinstatement, but for some money. And there are also cases that it says that only one reinstatement would be done, and for that we would take 120% of the initial premium. So these are the kind of arrangement that is mutually decided by the reinsurance and the insurance company. But the reinstatement point is very important, that we have unlimited free reinstatement over here. The third one is whatever losses was given to us in the question, we have taken it as it is. We haven't assumed that there would be further development, or we haven't assumed any IBNR on it. So the third assumption would be there is no further development on these losses, right? No further development, no IBNR, nothing we have assumed over here. Good. For fourth part, there is a stability clause for excess of loss reinsurance. Can anyone say what does stability clause mean? What do you mean by stability clause?
It means we are allowing for the limits in the for allowing for the inflation in the limits. Suppose inflation is going up, so our claim amounts will increase, then the larger proportion of the claim would be passed to reinsurance company. So just to avoid these kind of scenarios, we will be like allow for the inflation in the limits. We will inflate both
Correct,
the retention and the excess limit above limit.
correct. So stability clause is the inflation working for the attachment and the limit points. So as correctly mentioned, that if say we have 2.5 million to 5 million excess of loss, which was decided in 2009, right? The loss was registered over here, but by the time it settled, there was inflation working on it. The compensation that was decided grew up. Say it was settled in 2009. It would be growing up for 10 years. So now the losses that might have settled below, yeah, sorry, which might have settled below 2.5 million, with the effect of inflation, would go above 2.5 million. And in this 10 years, there is a good chance that the losses that would have not been in the reinsurance bucket previously would now come under reinsurance recovery, right? So for avoiding this, reinsurance company what they do, they attach a stability clause that this attachment point is in 2009 uh, real term, not in monetary term. It is in 2009 in real term. If there is a 6% inflation for 10 years, this 2.5 million would grow with 6% for 10 years. And now this has become the attachment point, and 5 million similarly. Now this is the limit point for the treaty. So over here, we haven't assumed any such stability clause. We haven't adjusted for inflation in that question, right? Because we haven't, first of all, we haven't taken any delays in payment. The losses were occurred in 2009, and we haven't adjusted it for any delays, growing settlement. So there is an assumption of no stability clause. Stability clause not there, right? Fifth, as I said that if there is a fact reinsurance, first we will apply this. After that, there is a quota share reinsurance, and ultimately the excess of loss gets applied. Over here in the question, we have been given with the quota share only. We are not taking in picture any other reinsurance that might have been purchased for any of the loss, right? So what are we saying? That there is no other inuring reinsurance in place. There is only quota share, only one reinsurance, inuring reinsurance that is given to us. There is no other inuring reinsurance. Sixth one is, so up until here we were making assumptions on what we have done. Now we are making assumptions in a common sense. So we will say that all claims are valid and they are paid. So there is no scenario where you have fought a case, might have won the uh, judgment, and there is no payment to be made. There is no such scenarios. Whatever claims get registered, you are paying it. It is a valid claim. There is no claim over here. So there is all claims are valid and paid. The seventh one is, since this is a property insurance claim, in the question we have also marked that this is a commercial property insurance book. For a property insurance book, what is the most common thing that we see? We see salvage and subrogation, right? Salvage and subrogation is one of the common thing that we see in a property book because there is some recovery that could be made by selling the remains of the insured product. We haven't considered any of this recovery, so no salvage or subrogation or other recoveries. So there is no kind of recoveries. So these are the assumption that we have taken. And these are the common assumptions. Like this is not related to this specific question. Any question which deals with reinsurance, recovery, and all, you could have this as your uh, go-to chart for assumptions. You could either use all of the assumptions from it or some of the assumptions depending on what the question is. So if the question says that you have a liability book, so in that case, this salvage and subrogation point won't hold true, right? Because for liability claims, there is no uh, salvage recoveries. So this seventh point would not be sensible for a liability claim, but can only be used for property claim. So this list could be used for most of the reinsurance questions wherever you have recoveries. And like all the questions would have assumptions in it. Wherever you have calculation questions, they ask what are the assumptions you have taken, and sometimes the assumptions carry more marks than the actual numerical that you solve. Say if 5 marks question is there, 2 marks is for calculation and 3 marks is for assumption. For calculating UPR, URR for finance for that questions, it is very often that the assumptions carry more marks than the actual calculation. So while we are solving, we will make a list. You also make a list of your own for assumptions so that whenever kind of questions come, you have all the assumptions in your mind that could be written to it. And you, in exam, you don't have to think of what kind of things we could find out in the question and what assumptions we could write. Let me know if you have taken all the assumptions. Good. So one more thing to understand over here, salvage and subrogation. First of all, we often use this term salvage and subrogation together. Is there a difference between salvage and subrogation, or it's a phrase that we use? Like, does this salvage and subrogation means something independently, or it have a meaning together only? Can anyone say?
So salvage is a if there is a total loss, like property is completely damaged, then uh we take the property. We take the suppose a vehicle is totally damaged. We take the vehicle from the insured and then sell it on our behalf on the scrap value. So that kind of recovery is salvage, and subrogation is like if there is a third party claim, like two vehicles are involved in the accident, then both can claim third party liability or own damage. In that scenario, we paid to our insured, and we can take the like legal responsibility from the insured, like it's the legal transfer of the rights, and we can fight the case fight the case against the another vehicle driver uh, on the behalf of the insured. So that's a subrogation.
Correct. So one thing that you mentioned was a key word, that subrogation is the transfer of right. So subrogation means that you have taken the right of the property from the insured to your hand. So the insurance company, the right of the insured property get transferred from the from the insured to the insurance company. From insured to the insurance company. So the act over here is called subrogation, where you have transferred the right, and now the reinsurance company could make any kind of recovery, whether from the third party or by selling the product. Any kind of recovery that is taken from the property is now insurance company's right. Salvage is the amount that we recover by selling that. If we are selling a property, what say remains of a car, that the recovery would be salvage. And over here, subrogation broadly means transfer of right of the property from the insured to insurance company, and now it is insurance company's right if any recovery is taken from this, it will belong to insurance company. The transfer of legal rights come under subrogation, and selling the remains is termed as salvage. Is it clear? Hmm. So another thing over here is reasons why we purchase reinsurance. This is very important, very frequently asked. So if you all remember, uh, what are the reasons? Like, let's first see how many reasons do you remember. What are the reasons for purchasing reinsurance? Whatever reason do you remember? Not necessarily will correct or from the book, from your common sense. What could be the reasons for buying a reinsurance?
Reduction in the volatility of the profits, claim amounts.
Reduction in volatility, correct?
Less
Yeah.
capital required
Less capital required, correct?
to expand the insurance business to new lines or to more riskier lines.
Expand. We can say that to expand to businesses that the company previously could not have written.
To gain the reinsurer expertise.
For reinsurer expertise, yes, technical expertise.
To improve the solvency of the company.
Improve solvency. How can very good question, very good matlab, point to improve the solvency. How can taking a reinsurance improve the solvency of a company? So this point over here is somewhat related to the first point. If you can link.
So I think the estimate of the reserves would be decreased in the future. So reserves would be our liability. So the liability would be decreased and the solvency would be improved. I believe.
Yeah. Yeah. So solvency over here is how much capital do you require? Required capital. SM, I guess it is RSM and ASM. I'm not sure about the abbreviation, but required solvency margin by available solvency margin. So the required solvency margin reduces. Why? Because when you take reinsurance, your volatility reduces. When your volatility reduces, risk reduces. The, so the capital required would also reduce. There is a capital required, right, by the company, depending on how much risk it is taking. If it is taking high risk, the regulator would require the company to hold more capital in order to protect the policyholders, right? So since the volatility has reduced, the required capital would reduce, and hence the solvency ratio would improve. So this solvency is related to volatility point. Next, does it has any impact on balance sheet taking reinsurance?
Yeah.
So by taking reinsurance, what are we doing? We are we are transferring some of the risk. It means that in each year we would have a similar kind of losses, right? If we have an excess of loss and we have capped our loss at say 1 billion each year, or so, say stop loss. The best example is stop loss reinsurance. If we have capped our loss at 1 billion loss, at in each year, the maximum loss could be 1 year. If say in all the years we have exhausted this 1 billion loss limit, so in every year we would have a 1 billion loss, 1 billion loss, 1 billion loss, 1 billion loss, 1 billion loss. It will help us project our future incomes, profits, right? And it would also smoothen our profits. If we didn't have this 1 billion loss, stop loss, or any kind of other reinsurance, what would happen? Our experience would be volatile. In certain years, we have a huge loss, say a very large loss have taken place, or any cat event has taken place. The insurance recovery shooted up. In other year, there is no such events. Very smooth year, profits are very abundant. In next year, there could be much larger loss than the first year. So what is happening? The profits are increasing, decreasing, increasing, decreasing each year. So the balance sheet is quite volatile. So reinsurance, purchasing reinsurance also help us smooth profits and balance sheet position. Next, it could be regulatory requirement. The most important point that we haven't touched over here is diversification. Reinsurance help us diversify our portfolio as well, right? With help of quota share, surplus reinsurance, we diversify our portfolio, right? How do we do it with the help of quota share? It is based on its reciprocal arrangement. So what does reciprocal arrangement in quota share mean?
Is it the commission we get from the reinsurer?
No.
Sure.
So say there is company A and then there is company B. Company A is writing only property business and company B over here is only writing casualty business. So A has a accumulation for property losses and company B has an accumulation for liability claims, right? So what they have decided that company A would pass 50% of its business to company B and similarly company B would also pass 50% of its business to company A. So what are they doing? They are reinsuring each other's business 50-50. So they have transferred each other risk because they all were having accumulation in their part. So they have transferred the risk. Now what is the portfolio mix for property for company A? 50% property, 50% liability. And same for B company, 50% property and 50% liability. So what have they done? They have transferred their risk, right? So there is a reciprocal arrangement. Company A gives business to company B. Company B gives business to company A. So reciprocal arrangement means arrangement between two companies wherein they transfer business within each other so that both of the company has a diversified portfolio. And how can we diversify using surplus reinsurance? So the biggest advantage of surplus reinsurance is that you don't have to transfer each risk in the same proportion. So say there is a commercial property insurance that you are doing, property A, property B, property C. Property A is a high risk property, property B is a normal risk property, and property C is a low risk property. So what you would do? You would say retain 20% of high risk business, 50% of normal business, and say 80% of low risk business. So in total, what have you done? You have balanced your portfolio. You have l- less portion of high risk, favorable business you have retained much, and for normal business you have a 50-50 share. So you have effectively diversified your portfolio for your advantage, right? So with the help of surplus insurance as well, we can diversify a portfolio basis. What risk do you want to retain more and what risk do you want to retain less? There is not like you would think that the reinsurance company is always at loss, would be always at loss in this scenario, but there is not the case. There are other features of surplus reinsurance that don't allow the insurance company to transfer all the bad risk to the reinsurance company and retain all the good risk to itself. There is again some participation that we have seen for the reinsurance layer as well. There is some minimum retention limit. So all those things works for surplus reinsurance. But the core thing is using reinsurance, you can diversify your portfolio. right? So now let's see, we have discussed a lot of points. There is again a tax point as well. Fronting captive, we would see. Let's see what are the points which is given in the book. Over here, it says profitability. This increases. How will it increase? For, say, excess of loss reinsurance, where you transfer some premium and losses are covered above a limit, it might be a case that for an excess of loss ratio of insured is less than the loss ratio of reinsured, right? In that case, you will be profitable. The insured will be, the insurance company would be profitable. This is not always the case because if reinsurance company is always on the profit side, sorry, if the insurance company is always on the profit side, from next year, either the premium would increase or he won't get a excess of loss cover from that very same company. So it's not always the case that you are in profitable situation, but taking reinsurance could help you make more profit. Second one is avoid large single loss. So this would be avoided by taking risk excess of loss reinsurance, right? If you have a very huge commercial property or a very high net worth person, say if you are insuring Adani, Ambani, their personal liability, they are high net worth individual attracted to high losses. So what would happen that a single loss, a single loss to them could impact the entire company and even can lead to the insolvency of the company. So, taking either excess of loss reinsurance or a facultative reinsurance, you could avoid having a single large loss in your portfolio. So, taking reinsurance also helps you avoid single large loss. Smoothen profit. We have understand how do we smooth profit by taking reinsurance. At some years, you would be in profitable situation. In other years, you would be at a loss situation, profitability loss. In average, you would smoothen your profits, smoothen your results. The next one is solvency improve. We have discussed how does it improve the solvency by reducing the volatility. So improving solvency, I think there is no improving volatility over here. We could write improving volatility as well. Sorry, reducing volatility. The next one is limit exposure to single event or accumulation. We have seen how we can limit our exposure using CAT, excess of loss, risk excess of loss, aggregate excess of loss, reinsurance. This all type of excess of loss reinsurance would help you limit your exposure to a single event or a series of events that could happen or multiple events in a year that could lead to huge losses. Accumulation of loss, what does it mean? Say if you have reinsured 10 household or 100 household in the same locality, if a flood happens in that area, all the 100 houses would be impacted. Losses would be registered from all the 100 losses. So you would have an aggregate large loss. The individual losses, each losses might not be that big, but you would have an aggregate large loss because uh, all the households were present uh, in the same locality, and they were subject to the same risk. So there is a accumulation of risk. Accumulation could be both geographically. Over here, we are seeing that all the households were present in the same locality. So there was a geographical accumulation of risk, and accumulation could also be by line of business. Say, in our example over here, for a diversification example, we saw that company A only has property business and company B only has casualty business. So there is an accumulation of property business for company A and accumulation of casualty business for company B. So accumulation could be both uh, geographical and line of business. Geographical accumulation and line of business. Maybe we can have accumulation. Increase the capacity of risk taking. So since our capital requirement has reduced, uh, we have a share of losses with the reinsurance company. And for a small company where it doesn't have much expertise, taking quota share would help him take more risk, increase the risk taking capacity, and also the point that we discussed over here, the insurance company might write business that previously he could not have written, right? So increased capacity to accept risk would mean now since we have reinsurance, it might take larger risk or can take more or could write more business, right? Since we have quota share reinsurance reduces your capital requirement, your solvency, gives you expertise of the reinsurance company. So this helps a new and a small growing business to write more business. Financial assistance, as we said, technical assistance, financial assistance over here means it is termed to uh, commission. So reciprocal was not commission, but financial assistance over here is commission. So for quota share reinsurance, we have discussed that for quota share reinsurance, we do get commissions. Commissions are of multiple types, right? Initial commission, profit commission. So for financial assistance, there are financial quota shares in place where there are overcompensating initial commission. So what do the reinsurance company do that say while writing the initial business, the company gave a 20% commission to its agents or underwriter or through whatever channels it has written the business, it has given 20% commission. But it has taken a quota share reinsurance wherein the initial commission is 40%. Although it has given 20% to the agents, but while writing a quota share reinsurance, it has gained 40% reinsurance, 40% commission. It also go as far as 80% commission. 80%, 90%. So very high commissions are paid initially. Why does it happen? They are overcompensating in terms of commission so that the current year position for the balance sheet that improves. So how does it impact? How, say, let's take an example. There is a property business, financial quota share has taken, we have taken financial quota share. there is 80% initial commission. And the quota share is 40% session. Okay, 40% seeding or session we have. So say if we have written 100 million of premium, we would seed 40 million. Net premium would be 60 million. Now 80% is the commission. So if we have given 40 million of business, we get 80% of it through commission. 32 million we again get back as a commission. 92 million. So this is our net position asset side पे. Asset side पे हमारा इस साल का net position is 92 million. Now say we have a assumed loss ratio of 90%. ठीक है, 90% loss ratio है. If we have written 100 million of business, 90 million would be my expected loss. If we have a 40% reinsurance, let's say that 45 million would be recovered and 45 million would be my net expected loss. Right. So in asset side, now I have 92 and in liability side, I have 45. So in net, we have a 47 million surplus. Right. If there was no reinsurance, what would happen? There was a 100 million loss, 90% loss ratio expected. Sorry, 100 million premium. So asset is 100 million, liability is 90 million. So my net position would have been 10 million for that financial year. For that financial year, my net position would have been 10 million. I have improved my financial position from 10 million to 45 million by taking a financial quota share. And why does we term this as financial quota share? Because see, we have taken an initial commission percentage of 80%. You would say that you have given 40 million of premium, you have taken 32 million as a commission, you have only paid 8 million. How can you justify that using this 8 million you have covered this 45 million? This doesn't happen. So over here, what are we doing? We are not transferring the risk. We are just transferring our financial burden to the insurance company. Initially, they have given us 32 million. There might be some capping to the loss, or finally, when the losses are settled, when the loss ratios are not in favor of the reinsurance company, they might ask for more premium or can reduce the profit uh, commission that they would have decided. So those kind of things happen, and this would happen in some other financial year. In that financial year, that might be we have taken another financial reach quota share, so the positions are getting net now. So financial reinsurance only helps you improve the financial position of that financial year. It would have impact in some other financial year. In that year, you would take some other arrangement, or might be that in that year your overall performances are good, so you would be able to easily absorb that losses. So these kind of financial assistance could be taken using reinsurance. And the last one is expertise. technical expertise, data expertise. New company might not have sufficient data to price, to reserve, to know where do we write reinsure sorry where do we write our business, which is the profitable location, which is a loss making location. Reinsurance company has all this information, right? So for a quota share, if you are in a quota share arrangement, the reinsurance company would be sharing its data. If not sharing the data directly, would help you, guide you where to write, because because the reinsurance company also has equal interest in your profitability, right? If you write bad business, the impact would transfer to the reinsurance company as well. So expertise and data transfer, these things mostly happen in quota share reinsurance, less for excess of loss, but can be there in excess of loss as well. Because for excess of loss also, it is in reinsurance company's interest to keep the insurance company losses low so that it doesn't fall in their bucket. So these are the reasons. There are other reasons: tax, regulatory requirements that we have considered, fronting. We will see fronting over here. If anyone knows what fronting is,
One insurance company accepts risk on behalf of another insurance company, and therefore they pass on the entire risk or the policy to the other insurer. So the first company is
yeah,
fronting for the second one.
correct. So over here, the fronting arrangement is a kind of dummy situation wherein company A and company B are involved in a transaction. Company A is writing the business and then ceding it back to company B. The actual burden of the risk lies with company B only. It is just that company A is in the front end writing the business. Why do companies do this? There is reasons for fronting. Might be that insurance company not be licensed to do business in that territory. It might be that some kind of insurance product requires the company to be local. The government requires that the local company can only sell these kind of policies. So there could be legal requirements which the company B doesn't wants to fulfill. So what is he doing? It's saying that company A, you write the business, you give me all the business, you cede me all the business, and keep certain percentage as your commission, as your profit with yourself, and the rest everything I will manage. I will pay for the losses. There could be tax advantage why they are doing it. Like say company A is registered in a tax favorable territory. If company B write business through company A, the tax liability is less. And now since you have just reinsured it, there might be different tax arrangement on reinsurance business. So you would have a tax advantage when you are writing business through a fronting unit because it might be situated in a tax favorable location. Bermuda is the most common example. You would see that Bermuda is a very small uh, land, but a lot of reinsurance and insurance companies are registered in Bermuda. It is because of tax advantage nature. There could be credit rating that impact. Company B might not have a good credit rating or good public image. If this company B sells the product, might be that no one takes the product or the credit rating is very bad, so there is no one backing company's B product. But company A has a good public image, has a good credit rating. Its policy could be taken at a higher premium as well since it has uh, good credit rating. So higher, it could write policies at higher premium and could be able to sell a lot of policies as well. So credit rating could be another reason. The last thing is relationship. There could be uh, some relationship between the company A and company B because of which they are doing it. It could be that company A is fronting of company B for a particular kind of business, and company B is fronting unit of company A for another. So there could be some reason, some relationship, some favorable uh, situation for both the companies for which they have decided to do this fronting business. There are another other reasons as well. Most of it expands to this points and another are individual. You could go through it. Reasons for fronting is another important uh, question that could be asked. Other than that, I guess we have covered most of it. Proportional, non-proportional, risk attaching. Over here, this is risk attaching. This is loss occurring. So to risk attaching. You can change this one. Risk attaching basis, loss occurring basis, and claims made basis. So it is similar to AY, UY, and RY. Accident year, underwriting year, and reporting year basis. We have almost covered the background and the type of reinsurance. There is one apted question which I would want you to do as a homework. This will help you get a better understanding of the type of products and in which scenario do you purchase what kind of products. So it says that suggest the type and extent of treaty reinsurance that would be most suitable. So we are talking about treaties first of all, and it is also saying that we can exclude financial reinsurance. So if we can quickly tell what kind of reinsurance arrangement would we target over here, that is treaty and excluding financial reinsurance. So what are the type of reinsurance? Type of reinsurance that we would be targeting over here.
So we have quota share, Excel. Like, do I answer right now, or shall we do it as a homework?
No, no, you can just tell me the type of reinsurance, then we can solve it as a homework. So
Okay.
quota share,
Excess of loss, and within that we can have risk Excel, cat Excel, and aggregate Excel.
risk, aggregate, and cat excel, right?
Um, and surplus,
Yes, we have surplus,
and then there is the one where we protect the loss ratio. I forgot the name.
stop, stop loss.
Stop loss. Yeah.
So these are the type of reinsurance. If we exclude the financial reinsurance and the treaty reinsurance, these two are proportional, these are non-proportional, and this is stop loss. So for these categories of reinsurance, you need to answer for each scenario what are the favorable reinsurance that you could take. I would share this question in the group. If you, so that's it for today. We have completed the first two chapters of Reinsurance, chapter 5 and chapter 6. It's important that you do your self-study for these. Reading the material is very important. If you have any doubt in any of the concepts, after reading this, after going through the material, after doing any sums, past paper, you can post in the group. We can have separate class, or we can discuss it in our next class as well.
Okay. And will the recording be available to us?
Yes, it will be available in your